Imagine having $100,000 in your bank account in just 6 months. Sounds too good to be true? Not if you understand the power of compound interest. Let's delve into the fascinating world of compound interest. In the simplest of terms, compound interest is the process where the interest you earn on your investment starts earning interest itself. It's like a snowball rolling down a hill, growing larger and faster as it goes along. This is the fundamental principle that has the potential to transform your $1,000 into a staggering $100,000. Now let's apply this concept to the roller coaster ride of stock trading. For the sake of simplicity, let's assume that you start with $1,000 and you make a 10% gain on each trade. And let's also assume that each trade takes 1 week to complete. In the first week, your $1,000 grows by 10% to become $1,100. In the second week, your $1,100 grows by another 10% to become $1,210. Notice that you made $110 in the second week, more than the $100 you made in the first week. That extra $10 is the magic of compound interest. If you continue this pattern, making 10% gains each week, your investment could potentially grow into a staggering $100,000 in just 6 months. Bear in mind, this is a simplified example. Real-life trading involves a lot more variables and risks, but it does illustrate the incredible potential of compound interest when applied to stock trading. This is not a get-rich-quick scheme. It's a strategic approach to investing that requires patience, discipline, and a keen understanding of the stock market. Now that you understand the power of compound interest, let's delve into the world of volatile yet quality stocks. So, what exactly are volatile yet quality stocks? Simply put, these are stocks that demonstrate significant price fluctuations in short periods of time, but are backed by solid companies with strong fundamentals. This means these companies have robust business models, healthy financials, and promising growth prospects, despite their stock prices bouncing around like a kangaroo on a trampoline. Let's consider a hypothetical example. Imagine a tech startup that has developed a groundbreaking new product. The company is fundamentally strong, with a capable management team and a clear path to profitability. But the stock price fluctuates wildly due to factors like market sentiment, regulatory news, or simply the inherent uncertainty of the tech industry. This is a classic example of a volatile yet quality stock. Now, why would anyone consider investing in such stocks? Well, the answer lies in the potential for high returns. These stocks can offer investors the opportunity to make substantial gains in a relatively short time. But remember, the flip side is also true. The same volatility that can lead to rapid gains can also cause sharp declines. Therefore, investing in these stocks requires a well-thought-out strategy and a good understanding of risk management. Think of it like surfing. The bigger and more unpredictable the wave, the higher the potential for an exhilarating ride, but also the greater the risk of a wipeout. So, as a surfer, or in this case, an investor, you need to have a strong understanding of the waves you're riding, and always be ready to adjust your strategy based on changing conditions. Volatile yet quality stocks are not for the faint-hearted. They require vigilance, resilience, and a willingness to take calculated risks. But with the right approach, they can be a powerful tool in your investment arsenal. Volatile yet quality stocks offer a unique opportunity for significant gains, but they also come with risks. The key to success is to manage these risks effectively. Candlesticks provide a visual representation of price movements in the stock market. Understanding them is crucial for successful trading. At their core, candlesticks represent 4 key pieces of information within a specific time frame: the opening price, the closing price, the highest price, and the lowest price. If you're looking at a one-day candlestick, for example, these prices correspond to the values for that day. Likewise, a 3-day candlestick encompasses these prices over a span of 3 days. The body of the candlestick is the region between the opening and closing prices. If the closing price is higher than the opening price, the body is typically colored or filled in, indicating a rise in the price. Conversely, if the opening price is higher than the closing price, the body is usually empty or a different color, signaling a decrease in price. The lines extending from the body, known as wicks or shadows, mark the highest and lowest prices during that time frame. The upper wick represents the high and the lower wick shows the low. The longer the wick, the greater the price fluctuation during that period. Now, individual candlesticks are informative, but it's the patterns they form over time that can really help predict future price movements. For instance, a bullish engulfing pattern might indicate a potential upward trend, while a bearish engulfing pattern could suggest a downward trend on the horizon. There's a whole library of these patterns, each with its own implications. Some are relatively common, like the doji, which signifies market indecision. Others are rarer, like the morning star, which could signal a bullish reversal. The key is to recognize these patterns and understand what they could indicate about the market sentiment. This isn't about predicting the future with absolute certainty. Rather, it's about improving your odds of making profitable decisions based on observable trends. Mastering candlestick patterns can give you a significant edge in the stock market, allowing you to spot potential opportunities and risks before others do. Knowing when to enter and exit a trade is one of the most important skills in stock trading. It can make the difference between a profitable trade and a losing one. Let's dive into a detailed strategy that will help you make these key decisions, especially when dealing with volatile yet quality stocks. Imagine you're on a roller coaster. The thrill comes from the steep climbs and the sudden drops, while stock trading can feel quite similar, especially when you're dealing with volatile stocks. The goal is to get on the ride at the right time and exit before the big drops. To do this, we need to understand the concept of support and resistance. Think of support as the floor and resistance as the ceiling. The stock price tends to bounce between these two levels. Our entry point, or when we buy, should ideally be near the support. Why? Because this is a level at which the stock price has rebounded previously. It's like a safety net. On the other hand, our exit point, or when we sell, should be near the resistance level. This is where the stock price has previously faced difficulty in rising further. It's like a glass ceiling. But how do you identify these levels? Well, that's where the candlestick patterns come into play. Remember the bullish engulfing pattern we discussed? This pattern, appearing near the support level, could be a good indication to enter a trade. Similarly, a bearish engulfing pattern near the resistance level might signal it's time to exit. However, it's crucial to note that these are not hard and fast rules. Stock trading is not an exact science, and there are always exceptions. But having a strategy and sticking to it can significantly increase the probability of making profitable trades. Let's take an example to illustrate this strategy. Imagine a stock that has been bouncing between $20 support and $25 resistance. If you notice a bullish engulfing pattern at around $20, this could be your cue to enter the trade. Then, if the stock rises, and you observe a bearish engulfing pattern near $25, it may be time to exit. By doing this, you could potentially make a profit of $5 per share. If you had invested $1,000, that's a 50% gain, turning your investment into $1,500. Repeat this process, and you can see how your investment could grow exponentially over time, thanks to the power of compounding. A well-planned entry and exit strategy can help you maximize your gains and minimize your losses. It's a critical component of successful stock trading. Now that we've covered the basics, it's time to put everything together. Let's take a moment to recap the main points we've discussed in this video. First, we explored the powerful concept of compound interest. This is the engine that drives your investment growth. By reinvesting the profits you make from each trade, you essentially create a snowball effect. Your initial investment, as small as $1,000, keeps growing and expanding, potentially blossoming into a whopping $100,000 in just 6 months. And remember, this is assuming a 10% gain per trade, which is a realistic target for volatile yet quality stocks. Speaking of volatile yet quality stocks, we delved into how to identify these golden opportunities. These are stocks that might see significant price swings, but they also have solid fundamentals. Their volatility is what gives you the chance to make substantial gains in a short period. However, the quality aspect is what reduces the risk of losing your investment. The key is to look for companies with strong financials, good management, and a competitive edge in their industry. Then, we demystified the world of candlestick patterns. Mastering these patterns can be a game changer for your trading strategy. They give you insights into market sentiment and potential price reversals, allowing you to time your entries and exits more accurately. Whether it's a bullish engulfing pattern signaling a potential upward move or a bearish harami indicating a possible downtrend, understanding these patterns can be your secret weapon in the market. Finally, we discussed a strategic approach to entries and exits. This is where the rubber meets the road. It's not enough to just spot a good opportunity, you need to know exactly when to get in and when to get out. We talked about setting profit-taking targets of 10 to 50% and how to use stop-loss orders to protect your downside. Remember, the goal isn't to win every trade but to come out ahead over the long run. So, how do all these elements fit together? It's like assembling a jigsaw puzzle. Each piece, understanding compound interest, identifying volatile yet quality stocks, mastering candlestick patterns, and implementing a strategic entry and exit strategy, contributes to the overall picture. They work in tandem to create a successful trading plan. Remember, success in the stock market isn't about luck, it's about strategy, patience, and discipline. With the right approach, you could turn $1,000 into $100,000 in just 6 months. The key is to start. Happy investing. Subscribe for more value.